This call is now being recorded.
Good morning, one and all. Welcome to my lecture on capital gains. Today in this class, we are going to take up some numerical problems on capital gains. Okay, before we go into the numerical problem, let's look at a particular capital asset. So here, the capital asset which we are dealing is distribution of capital asset on total or partial partition of a Hindu undivided family. Hindu undivided family. What does it mean? It means that see, at the time when the Hindu undivided family partially there is a partition. So the assets move from the Hindu undivided family to the individual persons who constitute the members of the Hindu undivided family, and hence there is no transfer and there is no transfer of capital asset. However, that capital asset once received by the individual member of the Hindu undivided family may further in the future course of action can transfer that particular capital asset. So please remember, transfer means sale. So however, capital, so that let's take up this distribution of capital asset by Hindu undivided family to its members on the partition of a Hindu undivided family is not treated as a transfer. It's not treated as a sale. For example, your father is Mr. X is there, and Mr. X is dividing the there is a division of undivided family, and Mr. X gets a part of the capital asset like land or building. So there is no transfer from HUF to its members. There is no transfer as such. So that can't be treated as a transfer, and thus there is no transfer of capital asset, and thus no capital gain arises in the hands of the Hindu members of the Hindu undivided family. Number one. So this is over. Number two, however, capital gain may subsequently arise when the asset received in the partition is sold by the member. Now, this member of the Hindu undivided family may subsequently in the future sell the goods, sell the capital asset or transfer the capital asset. So at that time, there is a element of transfer which has taken place, and we are supposed to find out whether it is a long-term capital asset or a short-term capital asset, and we have to find out whether LTCG or long-term capital gain or a short-term capital gain or a long-term capital loss or a short-term capital loss. For computing such capital gain in the hands of the member on the transfer of the such asset, we have to take into consideration this particular phenomenon. Cost of acquisition will be in the hands of the member of the Hindu undivided family. Cost means the cost at which that particular asset has been acquired. So we have to find out the indexed cost of acquisition or cost of acquisition. So what is the cost of acquisition? Period of holding from the date of acquisition. This is the period of holding, and cost will be the cost in the hands of the members of the Hindu undivided family. Now let's take a small example. With that, you will able to understand what we are talking about as far as this particular situation is concerned. So you can expect this kind of a question in your examination. Hope so there will be examination. So let's start the problem, numerical problem. The problem starts like this. Mr. S. Ramesh Kumar Mehta has inherited 5,000 debentures of Polyplex. So this problem is pertaining to able to see the heading. This particular problem is referring to numerical problem on distribution of capital asset on total or partial partition of Hindu undivided family and Hindu undivided family. So there is a partial or full partition of the Hindu divided family, and at the time when the Hindu undivided family is divided, or there is a capital asset which is inherited by the members of the Hindu underworld family. So this is the case on 28 6 2018, that is in the financial year 2018 2008 9. So you have to find out for the purpose CII, that is cost of inflation index, if required. Okay, Mr. S. Ramesh Kumar Mehta has inherited 5,000 debentures of Polyplex Limited. There was a company, there is a company by the name Polyplex, and the Hindu underworld family had purchased previously some years back Polyplex debentures, and he got, by virtue of this partition of Hindu underworld family, 5,000 debentures, and he got some gold also, and he got a house property also on such partition of the Hindu underworld family. So Hindu underworld family, there is a division, and in this division, yes, Ramesh Kumar Mehta, who is the assessee, got debentures, gold, and house property. So lucky he's getting debentures, 5,000 debentures, gold, and a house property. So let's, on what date he got it? On 28th June 2008. Okay, that was the date on which the partition took place. Now, what about the dates on which this debentures, gold, house property was purchased? Let's look. House was acquired by Hindu underworld family on 1/4/1999. So in this case, as the house property was purchased before 1/4/2001, so there should be fair market value. Yes, there is a fair market value. So that fair market value has to be taken into account. So this 5 lakhs versus 25 lakhs, whichever is highest, should be taken for the purpose of cost of acquisition. And this house property is 1999 house property, and it is sold. If you look here, somewhere here, if you look here, the house property was sold on to 28 2019. So almost 20 years later. So this house property was sold by whom? S. Ramesh Kumar Mehta. So it is a 20 years old house property. So it is a long-term capital asset. Now gold. Let's talk about the second one, which is gold. Gold was acquired by the Hindu underworld family on 1/8/2003 for rupees 4 lakhs. So in this case, the gold was acquired by the Hindu underworld family on 1/8/2003. That is in the year 2002, 2003, 2004. Okay, you have to remember this. 2003, 2004, it was acquired for 4 lakh rupees. And the debentures were acquired on 1/4/2006. So 2006, 2007 is the date of acquisition, or sorry, year of acquisition. And these debentures were acquired for rupees 10 lakhs. Now fair market value of the house property also is given. Now subsequently there was cost of improvement incurred by the Hindu underworld family on the house on 23/2004. That is in the year 2003, 2004. Okay, what does it mean? There was a house property which was acquired on 1/4/1999, but there was some improvement, means either the first floor was constructed or something like that has happened, and there is an addition to the house property in the year 2003 2004, and the cost incurred was 10 lakh rupees. So we have to do indexed cost of improvement, because this is sold after 15 years. So indexed cost of improvement has to be done. Now on 28 2019, this fellow S. Ramesh Kumar Mehta sold the house for 100 lakhs, and he has incurred 2% transfer charges. Sorry, gold he sold at 80 lakh rupees, and debentures he sold of the company at 25 lakh rupees. So from this, you have to find out the capital gains in the hands of compute the capital gains in the hands of S. Ramesh Kumar Mehta, because S. Ramesh Kumar Mehta is the person who is selling it. So he is the assessee, and tax will be paid by him if there is a capital gain or a short-term capital gain or a long-term capital gain, not the Hindu underworld family, because underworld family is the one who has parted with the properties, gold, debentures, and debentures and house property to Mr. S. Ramesh Kumar Mehta. So let's take up the solution. Let's take up the solution. Just wait for 2 seconds. So how to compute this problem? How to compute this problem? Now the solution is in front of you. Let's pay attention to the solution. So this was the introductory part. This was the numerical problem. Now let's look at the answer. Let's look at the answer and solve the answer. So the answer is in front of you. The answer is there. If you have any doubts, you can let me know. Just a moment. Hold on. Okay, nobody is there in the waiting room. So let's look at the answer. The answer is in front of you. The slide is there. So let's solve the numerical problem and compute what is the tax to be paid. What is the tax to be paid by Mr. S. Ramesh Kumar Mehta? And in this case, we will find out uh, the gain what he has got from sale of debentures, the gain what he has got from the sale of house property, the gain from sale of gold. Now, first one is sale consideration. So, Mr. S. Ramesh Kumar Mehta is selling this debentures, house property, and gold for 25 lakh rupees. If you remember, okay, here you can see 25 lakh rupees, 80 lakh rupees, and 100 lakh rupees. 25 lakh rupees, 80 lakh rupees, and 100 lakh rupees. That is 1 crore. Now, so you got the sale consideration figures. From this sale consideration, you have to deduct whatever are the expenses on the sale or on transfer. So you deduct, there is no expenses on transfer as far as excuse on debentures, but on the house property, when he was selling the house property, there were some brokerage expenses incurred by the assessee, and it is 2% on the sale consideration, which is 2 lakh rupees. And the gold also, well, while he was transferring the gold or selling the gold, there was no transfer expenses, so nil. So here net sale consideration. So you remember, sale consideration minus transfer expenses will give you net sale consideration, which is 25 lakh rupees. 100 lakhs minus 22 lakhs, sorry, is 98 lakh rupees. 80 lakh rupees minus nil amount towards brokerages is 80 lakh rupees. So this is over. So next is you have to find out indexed cost of acquisition and indexed cost of improvement for the respective debentures and house properties and gold, that is the capital assets. That is the capital assets. Okay, let's find the indexed cost of acquisition. Now, in case of debentures, please remember I am highlighting one important point. That point is, if debentures are sold or that is transferred, even though it is a long-term capital asset, it doesn't make any difference. No indexation is available. So I have written here, no indexation is available. So no indexation is available. Okay. So no indexation is available because that is the rule. You should not do any indexation as far as debentures are concerned. So what you have to do, you are not allowed for indexation. But however, whatever is the cost of acquisition, that has to be deducted. So debentures were acquired by the previous owner. Let's look at the previous owner. Who is the previous owner? In this case, the Hindu undivided family was the previous owner. And the previous owner, if you look carefully here, somewhere it is written here. Just look here. They have purchased these assets, which is debentures for rupees 10 lakhs. Okay, you can see it in the year on 1/4/2006. They have purchased these debentures for 10 lakh rupees. So 10 lakh rupees is the cost of acquisition. So here I have shown cost of acquisition, and I told you just now, in case of debentures, no indexation will be allowed. So this is the selling price, this is the cost price, and selling price minus cost price. In simple terminology I am using, you will get profit. So no indexation, and hence because of this, the profit in this case is 15 lakh rupees, because the selling price, the cost price was 10 lakh rupees, the selling price was 25 lakh rupees, and the profit in this particular case, that is a long term capital gain, is to the tune of rupees 15 lakhs, which rupees 15 lakhs. Hope you have understood it. So this particular asset has been dealt. This particular asset is dealt. So 25 lakhs minus cost of acquisition. So this is cost of acquisition. This is cost of acquisition. So 25 lakhs minus cost of acquisition, which is 10 lakhs. No improvement, because debentures or shares doesn't have any improvement. So cost, selling price minus cost price, that is net sale consideration minus cost of acquisition, will give you long-term capital gain. Because long-term capital gain, because this was purchased, if you look here, it was purchased on 1/4/2006, and hence it is sold in 2020. So 14 years old. So it is a long-term capital asset. Hope you have understood this. Now let's talk about the second one, which is house property. Let's look at a house property. House property was sold at a consideration of 1 crore rupees. If you remember, house property was purchased for 1 crore rupees. Was sold for 1 crore rupees. Okay, sorry, it is sold for 1 crore rupees. Look here, 100 lakhs. So that is a sale consideration. Now, what are the expenses incurred on transfer? It is 2%, which is 2 lakh rupees. So 100 lakhs minus 2 lakhs will give you net sale consideration of 98 lakh rupees. So this is the net sale consideration. But remember, we have to deduct from this one the cost of acquisition and the cost of improvement. Number one, number two. Now this asset, as far as building is concerned, was acquired on 1/4/1999 for rupees 5 lakhs, and the fair market value of this asset was on 1/4/2001 is rupees 25 lakhs. Okay, so hope you remember this. Fair market value was 25 lakhs. It was acquired for 5 lakhs, and it was acquired on 1/4/1999. So index cost of acquisition should be done. So we have done index cost of acquisition. So fair market value was 25 lakh rupees on 1/4/2001, and you have to compare this fair market value with the date of the price at which it was originally bought by the by the previous owner before 1/4/2001. So in this case, it was 5 lakh rupees. The Hindu undivided family purchased it at 5 lakh rupees. Among them, whichever is highest, that has to be taken for the purpose of calculation of index cost of acquisition. So what I took, 25 lakh rupees. So index cost of acquisition will be given by the formula now. Now let's do the formula part. So index cost of acquisition is equal to, as far as building is concerned, that is house property, is equal to index cost of acquisition is equal to fair market value into CII of year of transfer, and the year of transfer was in the year 2020-21, whose inflation index, as already spoken many a times, is 289, divided by, now here when you are taking fair market value of 1/4/2001. So at the bottom, that is the denominator, you have to take CII of 2001-2002, and 2001-2002, the base year, this is the base year, and for the base year, the cost of inflation index is 100. So now I substitute the figures. Fair market value is 25 lakhs. Number one. Number two is 289 is the inflation index of year of transfer by 100. So you will get some figure. Okay, I have not calculated that figure, but you can calculate on your own because I forgot to calculate. You can subsequently do it. Now, so this is index cost of acquisition. But see, do remember that this particular house property was having some additional improvements, means some first floor or second floor, something like that was taken place, or addition has taken place, or improvement has taken place. If you look here, yes, there is a improvement incurred by the house on the household on 23 2014 2004, sorry, for 10 lakh rupees. So once there is a improvement, that also has to be taken into consideration. Any improvement before 1/4/2001 should be ignored. Okay, that is one point. So index cost of improvement. Now, why index cost of improvement? Because this improvement was taken in the year 2003 2004, and it is a long term capital asset, and for a long term capital asset, in many of the cases indexation has to be done. For short term capital assets, you should not do indexation, but long term capital assets like house property and specified ones, you have to do it. So in this case also, in we are not talking about cost of improvement, we are going to talk about indexed cost of improvement. So this is given by the formula cost of improvement into CII of the year of transfer. So this will be always at the numerator, in the numerator, sorry, and CII of the year in which improvement took place, improvement took place. So we have done so many problems, so you may remember. So let's do the problem now. So index cost of improvement is equal to this one, cost of improvement. So the second floor or the first floor was constructed by the Hindu undivided family by spending 10 lakh rupees. By year of transfer, now this person Ramesh Mehta, who is the assessee, has sold in the year 2019-20. Yes, he has sold in 2019-20, and the inflation index of 2019-20, as already spoken, is 289. By CA of the year of transfer, CA of the year in which the improvement took place. The improvement took place in the year 2003 2004, and the CII of 2003 2004 is 109. Okay, you can subsequently look also. Okay, 2003 2009. I will show you once. So look here, 2003 2009. What is the look here? It is 100. 2003 2004. The CII is, if you are able to see it, it is 109. So hope you have understood this one. So here we will take at the denominator in the calculation of index cost of improvement 109. So 1 lakh into 289 by 109, you will get some figure. Okay, so this is cost of improvement and this is cost of acquisition. You add it and deduct it, and whatever amount you got, this amount you will deduct it from 98 lakhs, and there will be some figure that is called as long-term capital gain on the sale of house property. So number two, particular capital asset also has been dealt. Now let's talk about gold. Gold was also gifted to him on the day of partition to Mr. S. Ramesh Kumar Mehta in 2008 2009. Okay, so please remember this date, very important date, the date on which this particular house property, the gold was gifted to the by the Hindu undivided family to the assessee, who has subsequently sold, was Ramesh Kumar Mehta, and the gold was acquired was acquired on 1/8/2003. Okay, number one. Number two, when was the partition took place? The partition took place on this particular date. Please remember this date, 28/6/2008. These two dates are very important for solving the problem as far as gold is concerned. Now, gold was sold by Ramesh Kumar Mehta at 80 lakh rupees. Good. Is there any transfer? No. Expenses on transfer? No. So 80 lakhs minus 0 will give you 80 lakhs, which is net sale consideration, So this is also clear. Number three. Now let's talk about Is there an index cost of improvement? No, gold doesn't require largely any improvement, but house properties will require. So, here there is no improvement. So improvement is zero. But this gold was acquired by the Hindu undivided family. If you remember, the gold was acquired by the Hindu undivided family on 1/8/2003. Okay, so 1/8/2003 was the year in which the gold was received by the was purchased by the house by the Hindu undivided family. But when did the partition took place? Partition took place. I am writing the dates. Partition took place. If you look here, 28/6/2008. The partition of the Hindu undivided family took place on 28/6/2008. So these two basic things are required for finding out what type of capital asset. So the type of capital asset, and we have to find out whether it is a long-term capital asset or a short-term capital asset. So for the purpose of finding out the gold, whether it is a long-term or short-term, so we have to take into consideration when the Hindu undivided family procured this gold. It was in 2003, and this gold was sold by assessee in the year 2019-20. So it's almost from 2003 to 2019, more than 3 years, 16 years. So it is a long-term capital asset. So it is a long-term capital asset, number one. So this is over. Number two, is it sold? Yes, Ramesh Kumar Mehta is selling that gold. Now, number two is also over. Number two is also over. Number three, now we have calculated up to this stage, indexed cost of acquisition has to be done. Indexed cost of acquisition is equal to, because it is a long-term capital asset, indexed cost of acquisition has to be done. That is cost of acquisition into CII of the year of transfer, by CII of the year in which, okay, there is a small mistake I might have committed. Okay, I'm not sure. CII of the year in which the asset was acquired from the previous year, from the previous owner. This is very important. So here I have made a small mistake. Please take into account this one. Okay, this is going to be changing. Okay, so here indexed cost of acquisition is equal to cost of acquisition into CIR of the year of transfer by CII of the year in which the asset was first time acquired by the assessee from the previous owner. Previous owner was the Hindu undivided family. Hindu undivided family gifted it to Mr. Ramesh Mehta. When was it gifted? If you remember, it was gifted by virtue of the partition of the Hindu divided family in the year 2008-2009. So 2008-2009, this index cost of inflation has to be taken into account. So let's solve it. So COA, gold was acquired at 80 lakh rupees. So 80 lakh rupees into CII of the year of transfer. This guy Ramesh Mehta sold in the year 2019-20, and the inflation index is 289. Divided by, now this person got Ramesh Mehta got the asset for the first time in the year 2008-2009. So the cost of inflation index of 2008-2009 has to be taken into account. By mistake, I have taken 109. Okay, so replace this one and calculate. You will get some figure. So this will be the index cost of acquisition. So there is no improvement. From 80 lakh rupees, you deduct this index cost of acquisition. There is a small mistake here, so you can rectify that. And the remaining residual is called as long-term capital gain. So this is also clear. So next one, there is another asset what we are going to deal. So till now we have dealt with only one asset, which is on the division of Hindu undivided family. There are assets which are distributed to the members of the Hindu undivided family. So that is a peculiar situation, a strange situation, a new situation. But now we are going to talk about another situation where the situation goes like this. So many situations are there in capital assets under the chapter capital assets, or that is capital gain. Now transfer of capital assets in a scheme of amalgamation by amalgamating company to the amalgamated company. Okay, we will not go into what is amalgamating company and all that stuff. I will give a small example. Messrs. ABC Company Limited is there. ABC limited company is there, and there is a Messrs XYZ limited company is there. Okay, I am just giving the meaning of this what we are discussing. So I am a shareholder. For example, I am a shareholder. S. Ramesh Kumar Mehta is a shareholder in this company. Okay, and there are some assets which are there in this company. Okay, now this company was subsequently merged. So you can just disregard this one. We are talking about capital assets transferred from this company to this company. Now this company is getting amalgamated or merged into this company. So on the date of, so this is not a case of transfer of assets or sale of assets. Is there a sale of assets? No, absolutely there is no question of sale, because if they are getting merged, they are not going to, they are not transferred. So in this case, let's see if subsequently this company is selling the assets. So amalgamated company is transferring assets to amalgamated company. Amalgamating company, this is amalgamating company, transfer its assets to amalgamated company. So cost to amalgamated company. Now what will be the cost in the hands of this one? Cost to the amalgamating company. This is the cost to the cost of amalgamating company. Previous years, period of holding include period of holding of amalgamating company. So this amalgamating company, when did they purchase these assets? From that day onwards, you have to take into account indexation. Very important. From the date of acquisition of the capital asset by amalgamating company. From the date of acquisition of capital asset by the amalgamating company. This is the amalgamating company. Okay. So let's take a small numerical problem, and we will solve it, because there are so many situations like this. So I hope there will be some problems also like this. So there are so many instances. For example, there is one more instance like this. So I'm just showing you the slide, and let me explain to it this slide also. Transfer of capital assets in the scheme of demerger. Demerger company is transferring assets to resulting Indian company. For example, there is a company by name ABC Limited. Now, what do you mean by demerger? There is a small, there are 5 factories in ABC Limited. Factory 1, Factory 2, Factory 3, and Factory 4, and Factory 5. Opposite of merger is demerger. Please remember that point. Opposite of merger is nothing but demerger. Merger means unite. Demerger is split. Very important words in taxation as well as in company or company law. Okay. Now this company has 5 factories. Now these 2 factories are getting separated from ABC and forming a new company, for example, XYZ Limited. So these assets were previously with ABC. Now these assets are going into a new company, that is a demerged company, which is called as XYZ Limited company. So there can be instance like this also, which is opposite of merger. So the asset was held by this one, is subsequently going into the hands of XYZ Limited company. So is there a transfer or not? We'll see. Next one is allotment of shares by amalgamating. This is another situation. There are so many situations. I am telling you very frankly. This particular chapter is a very voluminous, humongous chapter. There is a lot of things to be. There are a lot of things to be dealt. So I'm trying my level best to cover the maximum of the assets. Next one, another example. Now let's take another example, another particular instance, allotment of shares by amalgamated company in lieu of shares of amalgamating company. Now there are 2 companies, amalgamated company, and amalgamating companies. So confusing, okay? But you have to be very clear about the definitions and the meaning of amalgamating companies and amalgamated companies. Okay. Now I will give a small example. For example, S. Ramesh Kumar Mehta was having some 50,000 shares of XYZ Limited company. Now this company is getting amalgamated in this company, which is, for example, PQR Limited company. Okay, again I am explaining this concept. Please pay attention. There is a company called as XYZ Limited company. There is another company by name PQR Limited. Now SRK Mehta has got some shares in XYZ Limited company. This is number 2 point. How many shares he got? 50,000 shares of XYZ Limited company. Now this XYZ Limited company is getting amalgamated in PQR Limited company after some 5-10 years like that, and it loses this loses its identity. And number three is, now I am not, these shares of this company which I am previously holding are of no value, and the amalgamating company PQR Limited will issue new shares to me because of the virtue of some shares which were held by me in XYZ Limited, which were 50,000 in a particular predetermined ratio. So now subsequently, this shares of this company are issued to the shareholder S. Ramesh Kumar Mehta, for example, 25,000 shares. And he is now selling after 5 years from the date of amalgamation. So let's look what is the answer to this also. So this is the third situation. Now another situation is there. Again, another situation. So this is the fourth situation. So many situations, so many people are involved, and they can come to you for consultancy, and you should be prepared to answer that. Allotment of shares of resulting company to the shareholders of demerged company. Okay, there can be a situation like this also, and you have to shares in the resulting company, shares of the resulting company, and shares of the demerged company, and all that stuff is given. So when there is a problem, we will take up. Now let's take up a numerical problem, because explaining them the concept with the help of numerical illustration gives a lot of clarity as far as the concept is concerned. Let's do the problem. Excuse. Yes, Ramesh Kumar Mehta acquired 5,000 shares in Steel Power India Limited. So Steel Power India Limited, 5,000 shares of 3 lakh rupees. When did he acquire? He acquired, okay, this is one part. Now, subsequently, Steel and Power India Limited was demerged. Demerged means they were separated, and in the process, the net book value of the asset was transferred to SPI Limited, the resulting company. So at the time when it was demerged, this company was demerged on 24/8/2019. Okay. And in the process, the net book value of the assets of this company which was demerged, went to the hands of a SPI Limited, which is the resulting company. SPI Limited is the resulting company. Okay, this is number 2. Compute the cost of acquisition of Mr. S. Ramesh Kumar Mehta in the demerged company as well as resulting company, assuming that the paid up capital, okay, before demerger were. So this particular data is given. What is the data? Yes, compute the cost of acquisition of shares of S. Ramesh Kumar Mehta. That is this particular they are talking about, as well as resulting company. So subsequently, these shares were replaced or exchanged by a new company shares, that is Steel and SPI Limited. Okay. So in place of 5,000 shares, they are giving this. That is what is the resulting company is. Assuming that the paid up capital and reserves and surplus of Steel and Power India Limited before demerger was 2 crores. So before the demerger, the paid up capital and the general reserves and surplus of this particular company, which is the original company, is 2 crore rupees. So with this data, we will find something related to the question. So let's look the question. So you have got some formulas, and that formulas have to be taken into account. So shares in the resulting company. What are we trying to find out? The shares of the resulting company is we are finding out the cost of acquisition, because see, this guy may be subsequently selling these shares, but he doesn't have these shares now. He has got the new shares of the new demerged company, which is SPI Limited. So to find out these particular shares when they are sold subsequently by the assessee in the open market, we have to find out at what price these were previously purchased. To find out that, we have a formula. The formula is cost of shares in the demerged company, cost of acquisition of shares in the demerged company into net book value of the asset in the demerged company after demerger by net book value of the asset in the demerged company before demerger. So this formula you have to remember. Next one is shares in the demerged company. Now, what is the cost of acquisition? So demerged company was previously this one, Steel and Power India Limited. So cost of acquisition of shares in the demerged company is cost apportioned to the shares of the resultant company. We will see the answer to this. So first and foremost, what is the cost of acquisition in the resulting company? In the resulting company. So this is already told, but it is given by the formula cost of acquisition of the shares in the demerged company. So this demerged company was the company which got demerged. It was Steel Power India Limited, and the shares which was held by him was 3 lakh rupees. So into net book value of the asset in the demerged company after demerger and net book value of the asset in the demerged company before demerger. So it is given here before after the demerger it was 50 lakh rupees, and after, before the demerger it was 2 crores. So 50 lakhs by 2 lakhs is equal to 75 lakh, 5,000. So this is one part. So I think this is a bit complicated, but just I'm explaining shares in the demerged company. So cost of shares in the demerged company is equal to cost of acquisition is equal to cost of shares in the demerged company minus the cost apportioned to the shares of the resulting company. That is the cost of the demerged company was 3 lakh rupees, and this 75,000 rupees what you got, you have to just minus it. This is the cost of acquisition of the shares in the demerged company. So let's not take a lot of view on this. Next one. So let's take this particular example, this particular situation. Conversion of bonds or debentures into shares. Cost of there is a conversion of debentures or bond into shares. Now, before I go into the explanation, let's clear the concepts. Let's clear the concepts. What do you mean by conversion of bonds or debentures into shares? So if you look on the equity share capital, on the liability side of equity share capital, liability side of balance sheet, sorry, you will have equity share capital, you get reserves and surplus, you get debentures, you have bonds under the heading debt capital. Okay. Now, what do you mean by bonds or debentures? It is nothing but a debt instrument issued by the company, and those who are invested, those who have invested are called as debenture holders, and the company has got a capital in the form of debt capital, and this is a part of your what do you call capital employed in the company. So equity share capital, reserves and surplus, debentures, bonds, long-term loans from bank, and preferential capital. If you add together, you will get capital employed in the company. Now I'm referring to these two things, and in particular I'm talking to about debentures. Debentures is a long-term source of capital for any company, just like your equity share capital or bank loan or bonds. Now debentures have got some characteristics, and one characteristics of debentures is they are convertible debentures. Convertible debentures means what? They are going to be converted into equity shares at a appropriate time, either on the date of maturity or an appropriate predetermined time. So this is the meaning of debentures. They are subsequently converted into equity shares. So they can be fully convertible debentures or partly convertible debentures. So these debentures are converted into shares, and these shares are subsequently sold in the market. So we have to find out as usual, the net sale consideration and the cost of acquisition and the period of holding. Okay, so this is again the same process. Let's take up a small problem, and this problem I will tell you will sure help you to understand the concept as far as conversion of bond or debentures into shares. Okay, let's solve the problem. Yes, Ramesh Kumar Mehta bought convertible debentures, or you can use the word invested in convertible debentures of rupees 15 lakhs in August 2002. That is in the year 2002 to 2003. First and foremost, that is the point. The year in which it has been acquired, these debentures are acquired, was in the year 2001, 2002, 2003. Okay, hope this is clear. And what was the amount he has invested in these debentures? 15 lakh rupees. Now, subsequently, these debentures on a predetermined date were converted by the company, which is DB Softwares, by the provisions of the law or by the terms and conditions of the issue of debentures, were converted into equity shares. So 15 lakh rupees of debentures were converted into equity shares on which date? On April 2013, that is 2013 2014. This is number two. These shares were sold. Now he has got some shares. Okay, these shares were sold for rupees 1 crore 50 lakhs. 1 crore 50 lakhs. By whom? By Ramesh Kumar Mehta. And the brokerage charges incurred on such transfer was 1 lakh rupees. Now compute the long term, compute the capital gains. So let's discuss the solution, and then we will look at the numerical slide of the numerical which contains a slide which contains the numerical solution. So 15 lakh rupees of debentures were purchased, and then they were converted into shares, and these shares were sold. That is the main theme. These shares were sold in 2019-20, and these debentures were purchased in the year 2002-2003, and these debentures were converted in the year 2013-14. So what is this asset which is sold? This is a conversion of debentures into bonds, number one. Number two, we have to find out whether it is a conversion or not. From year to year there is no conversion, but shares were subsequently sold, so there is a sale. Number two. Number three, is it a capital asset? Yes, shares are capital assets and debentures also are capital assets. Number three. Number four, whether it is a long-term capital asset or a short-term capital asset. If you calculate the period of holding, which is very important concept, period of holding. Period of holding was they were acquired, debentures were acquired in 2002, and they were sold, and subsequently because of conversion to shares, these shares were sold in 2019-20. So it is almost 18 years. So it is a long-term capital asset. It is a long-term capital asset. So if you sell long-term capital asset, you will get either capital gain, long-term capital gain, or long-term capital asset. So we will find out long-term capital gain or a short-term long-term capital loss. Number three. Number four is what is cost of acquisition? Because cost of acquisition has to be found out. The cost of acquisition is the shares are purchased. The shares are purchased. The shares are sold, but the shares were originally debentures, and these debentures were converted. So these debentures were acquired. That will be the cost of acquisition as far as shares are concerned. So cost of acquisition is 15 lakh rupees. Now with this data, let's solve the problem. So you have indexed cost of cost of induction table also. Let's solve the problem. So sale consideration. इन्होंने जो shares आए थे उन पूरे के पूरे shares they were sold at 1 crore 50 lakhs. So there is no doubt about this one. If you have doubts, you can look here. They sold at 1 crore 50 lakh rupees, and on such conversion, the brokerage charges were 1 lakh rupees. So 1 crore 50 lakhs minus 1 lakh is the net sale consideration, which is 1 crore 49 lakhs. So this is also clear. Now Is there an improvement? No. Shares and debentures doesn't have any improvement as such, like a physical asset. Now, cost of we have to do index cost of acquisition. Why? Index cost of acquisition has to be done because it is a long-term capital assets, and this is a share, and equity shares which are sold are long-term capital assets, and it has to be indexed. So let's talk about index cost of acquisition of these shares. Let's talk about index cost of acquisition of shares. See, remember, debentures are not sold, shares are sold. For debentures, there is no question of indexation, but debentures converted into bonds or debentures converted into, sorry, equity shares, and equity shares are sold, so indexation is allowed. So indexed cost of acquisition is equal to cost of acquisition into CII of year of transfer by CII of year of acquisition of debentures, because shares were not purchased, it were originally debentures which were converted. So we have to take cost of acquisition of debentures and the year of indexation of the, sorry, inflation index of the year of purchase or acquisition of debentures. So if you calculate, we will get answer like this: 15 lakh rupees, which was the debentures cost price, into CA of the year of transfer, that is 289. In the year 2019-20 it was sold, so every time this will come on the in the numerator, by CA of the year of acquisition of debentures. This acquisition of debentures was in the year, if you look carefully, in the year, if you look here, August 2000 means 2002 2003. So 2002 2003 it is 105. So divide by 105. Divide by 105. So if you look at the solution also, 15 lakhs into 289 by 105, and the 2002 2003 is the year which we have taken in the for the indexation for the CII. So if you calculate 15 lakhs into 289 by 105, we will get 41 lakhs 28,571, which is index cost of acquisition. Which is index cost of acquisition. So hope this is also clear. See, you can expect this kind of questions in your examination, and please remember, all these recorded videos I am going to upload on the YouTube. Don't worry. So 1 crore 49 lakhs is the sales, net sale consideration, minus purchase price in simple terminology. So this is nothing but the index cost of acquisition. So sales minus cost price will give you profit. So we are not using the word cost price or purchase price. We use the word index cost of acquisition. So 41 lakhs 28,571 is the index cost of acquisition. The sales price, net sale consideration was 1 crore 49 lakhs. So he made a bumper profit of 1 crore 7 lakhs 71,000 1 crore 7 lakhs 71,429. 1 crore 77 lakhs 1,429. So on this he has to pay 20% long-term capital gain tax. Long-term capital gain tax to the tune of 20% on this one. 1 crore means almost 20 lakh rupees he has to pay tax. So this is also loud and clear. Now let's take another example. So this is very excellent example. Let's do the problem. Conversion of inventory into capital assets. Conversion of another capital asset. We are dealing conversion of inventory into capital assets. So for example, Mr. X is there. Very important. Please, this particular concept is very important. Mr. X is there, and he had purchased some 20 buildings. He is very rich person, like Sakshi and Akshada. They are very rich. This guy also is very rich person. How many buildings he has got? 20 buildings. Okay, so these buildings were subsequently converted into capital asset. now, okay, sorry. This building was sold. So this can be one situation. Other thing. Otherwise, Mr. X is there. He's a real estate owner. He is a business. He is a person doing business in real estate, and he has got some 30 buildings which were supposed to be sold. 30 buildings, flats, which were supposed to be sold, but he is not interested in selling them because he's assuming that the prices will go in the future. So he has converted them into inventory. Inventory means conversion of invent. So he has converted them into capital asset. Sorry. So whatever was the inventory previously was converted into capital asset. So I will explain the concept once again because there is an element of doubt. There can be an element of doubt. So for example, Mr. X is there. This X is a real estate businessman. His business is real estate, and he has got some 400 houses or flats which he has constructed for the purpose of selling. So this is the inventory got as far as the buildings are concerned or the flats are concerned. Now he's not interested. He's not interested to sell. Now what he did, he converted this inventory into capital asset. So this can happen. So when inventory is converted into or treated as capital asset, the fair market value of such inventory on the date of conversion is considered as a business income. So if such capital asset is transferred, then it will be treated as under. Okay. Now again, I'm recapping this particular point. When this inventory was 400 flats, which he converted into capital asset. He doesn't want. He is not inclining to sell it. He converted into property of his own. So previously it was inventory which was converted into capital asset. So there is no question of transfer. There is no question of transfer. It is not a sale. So so there is no question of transfer. So at this time, the fair market value of such inventory as on the date of such conversion date is considered as business income. Is considered as business income, not a capital asset or capital gain. And if this capital asset is subsequently sold, if this capital asset is transferred, then it will be treated as a capital asset being sold. So inventory converted into capital asset and capital asset is subsequently sold. Okay. So cost of acquisition is the fair market value of such inventory at the time of conversion. Period of holding will be the date on which starts from the date of conversion or treatment. We'll see that. Benefit of indexation available from the year of such conversion treatment. So let's take a small example. Little bit confusing, but once we take up a numerical problem, whatever doubts are there, it will be loud and clear. Mr. S. Ramesh Kumar Mehta furnished the following information. Short-term capital gain on transfer of shares on which STT is. So this is a different problem. Okay. The short-term capital gain on transfer of shares on which STT is 2,05,000 rupees. Other income is 1,09,000. Calculate the tax of Mr. S. Ramesh Kumar Mehta. So we don't have a problem as such of the previous particular asset. I will take up some numerical problem in the next subsequent class. So in this case, S. Ramesh Kumar Mehta furnished the following information which he had in the financial year 2019-20. That is, he has sold some asset within 12 months or 36 months, depending upon the character of the asset, and he has sold it within 12 months. In case of shares, it is 12 months, and in case of buildings or other assets, within 36 months, if it is sold, it is a short-term capital asset. But it is a case of a share because these are the shares which are sold, and once you are selling shares, in the process of transferring of shares, you have to pay to the stock exchange a tax called as securities transaction tax. STT stands for security transaction tax. On this, he has paid securities transaction tax, and he made a capital gain of 2,05,000. So on this 2,05,000, this is a long-term capital gain. You have to pay 15% tax. Sorry, short-term capital gain. You have to pay 15% STCGT, short-term capital gain tax. Now, other income can be income from salary, income from house property, income from business, or income from the other source like interest, dividend, was 1,90,000. His age is 47 years. So compute his total amount of tax to be paid. Now look here. Look here. So if you remember my first class, from 0 to 2.5 lakh rupees, there is no tax because his age is 47. He is below 60. So for this, up to 2.5 lakhs, no tax. 2.5 lakhs to 5 lakhs is 5 percentage. If you remember, 5 lakhs to 10 lakhs, it is 20 percentage. The very first class or second class, and more than 10 lakhs, it is 30 percentage plus 30 percentage plus surcharge. Okay, all that stuff you remember. So now his income is 1,70,000 and 1,50,000. 1,70,000 and 1,50,000. One is other income and one is short-term capital gain. Now, what is the first point? The first point is up to 2.5 lakh rupees, we need not pay any tax. But on short-term capital gain, he has to pay 15% tax. So now look at this. Our exemption limit on which no tax is charged is 2.5 lakh rupees. Okay, so I told you that up to 2.5 lakhs rupees, you need not pay anything. So in this case, this particular income up to 2.5 lakh rupees, you need not pay anything. So you have deducted 2.5 lakhs from 1,70,000. So you have to please remember. Okay, it goes like this: 2.5 lakhs up to 2.5 lakhs, he need not pay anything. Let's look like this: 1,70,000 is income from other source, and short-term capital gain is 1,50,000. So first 1,70,000, there is no zero. So again, in this 1,80,000 up to 80,000, because 1,70,000 plus 80,000 is 2.5 lakh rupees on which you need not pay anything. That is zero. But over and above is how much? It is 80,000. So on this 80,000 rupees, sorry, 70,000 rupees, sorry, 1,70,000 plus 80 is 2.5 lakhs. Total income was 3,20,000. So 3,20,000 minus 2.5 lakhs is 70,000. So this is a short-term capital gain on which eventual short-term capital gain on which he has to pay tax. So on this 70,000, which is the income, you should not go to this tax slab because short-term capital gain will have a separate tax which is called as 15%. Sorry. So on this 70,000 rupees, 15% has to be paid, which is 10,500. So this is also a different kind of situation. So again, I am just recovering this particular problem for your convenience and for your better understanding. You see, income from other source was 1,70,000 rupees. His income from short-term capital gain was 1.5 lakh rupees. So the rule says that 0 to 2.5 lakhs nil, 2.5 to 5 lakhs is 5 percentage, 5 lakhs to 10 lakhs is 20 percentage, and 10 lakhs and above it is 30%. 30 percentage. So this is the tax slab for the assessment year 2021 for the guy who is below the age of 60 years. Now this guy falls under this category. So, however, this case, if you look at the problem is this guy is having 3,20,000 as income. 3,20,000 as income. 3,20,000 as income. So up to 2.5 lakhs nil. Now what I did, this 2,50,000, how should I compute? So other income 1,70,000 I will deduct, and another from this 80,000 I will deduct, which will become total 2,50,000. But the pending of this one is 70,000. On this is the short-term capital gain on which he has to pay tax, and the short-term capital gain tax is 15%. So 70,000, sorry, here this is a small mistake, 70,000 into 15%, you have to pay 10,500 rupees as tax. So in the next class, when we meet on the next class, we will take up some more numerical problems. Hope you have understood everything, and I am thankful to you for joining my session. If you have any doubts, you can let me know. Just a moment, okay? Thank you so much and have a good day. And thank you so much. Just a moment, okay?